I've been doing this for 36 years. So I think I've had 9 bear markets. Of course, Wall Street says it's always the 1,000-year flood, except it happens every 4 or 5 years. But the problem with this one is it's completely self-inflicted. There is no reason for this. I mean, the last similar market reaction would have been the COVID-19 story back in March of 2020. So it's almost like Donald Trump has now become the COVID virus. And unfortunately, unlike COVID, there's no cure. The first term, it was a lot of people that were former Republicans and they were trying to guide him. He would have done all of the stuff that he's doing right now in 2018, but he just didn't have the staff in place to implement it. So we're here now, but it's not unfortunately not going to end well. It's going to be very ugly.
Anthony Scaramucci knows a thing or two about market chaos. After 36 years in finance, he's seen 9 bear markets, and Wall Street's favorite line is always that each one is a once-in-a-century event. Funny how those seem to hit every 4 or 5 years. But this time, there's no external shock like COVID-19 in 2020 to blame. This meltdown is pure political dysfunction, and Scaramucci doesn't mince words. Trump has become a significant factor affecting the market, and there's no easy solution. Back in Trump's first term, old-school Republicans kept him in check, barely. Now, with a more loyal and less restrained team around him, policies that spook investors are rolling out unchecked. Scaramucci points out the irony. Trump could have done all this back in 2018, but the guardrails were still on. Now, no such luck. Markets hate uncertainty, and this drama isn't ending anytime soon. And let's be real, this situation goes beyond just stocks. When Washington, D.C. becomes a circus, it affects everything, from borrowing costs to consumer confidence, and even global trust in the U.S. economy. Scaramucci's view is clear. Prepare for a rough ride. History shows that self-inflicted wounds take longer to heal, and the fallout could be significant. For investors, it's no longer about buying the dip. It's about waiting for the smoke to clear. The problem isn't just in the markets, it's in the White House. Let's watch clips from Anthony Scaramucci's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
I don't think anybody should be surprised. I mean, this is the reason why I was offering out warnings prior to November the 5th. I said that he would do exactly this, and this would have catastrophic consequences for the markets. It would have catastrophic consequences for the global economy. I mean, if you and I got in a room and said, okay, here's what we need to do. Let's see if we can dismantle the world's trading system, weaken the United States, and let's see if we can disenfranchise ourselves from our European allies and other nations where we had strong, reliant partnerships in. And let's see if we can help the Chinese and the Russians. I don't think you and I could have come up with a better plan. I mean, this took 7 Scaramucci's or 77 days, and this guy is, really hurt the country. And what's astonishing to me is he has very smart people around him that know better. Yeah. But this is an American Brexit. And just stay with me for 1 second. When you guys made the decision to Brexit in the United Kingdom, the economic data was against you. People said, please don't Brexit. You're going to hurt yourselves and you're going to lower your living standards. You guys Brexit. Eight years later, you hurt yourselves and lowered your living standards. And so this is exactly what the United States is doing right now. This is an American Brexit from the global trading community. And remember, he's hurting American workers. He's trying to say, well, the 1% owns the stock market, but that's categorically not true because firemen, police officers, other service providers have their retirement money locked in these large-scale institutional pension funds. And so, he's hurting those people. He's annihilating them. You've taken $8 trillion out of the U.S. market, $13 trillion out of the global market. So at some point, those people will say, okay, enough is enough. And so if he stays on this course trajectory and we're likely now to see a recession, 70% chance to get a recession, even if the Fed starts cutting rates, he'll lose his poll standings. Remember, he's only at 36% approval as it relates to trade. I think the narrative, this is the interesting point about it, the narrative that's being chanted on your sister network, Fox News, et cetera, is actually a false narrative. No, they're not allowing people like myself to come on and provide the counter narrative. So this notion that the tariffs are going to reset the trade system and it's going to reshore manufacturing into the United States, it just doesn't understand the current system in the world. As an example, if you want to purchase a Boeing aircraft, which is an American-made aircraft, 45% of the components are from outside the United States. If you want to add the electronic components like the flat screens that go in the back of the plane or the flat screens that go in the pilot's cockpit, you've got 60+% of the aircraft is actually manufactured outside of the United States and installed here in the U.S. So you're going to knock the price of that airplane up 50 to 60%. He's calling for an additional 50% tariff on April 9th on the Chinese. So that's an 84% tariff. China is the Saudi Arabia of manufacturing. So whether you like that or not, that's where we are. He could have achieved his goals doing something more moderate. And he probably could have touched off an economic boom, but now he's going to cause a global recession. Let me posit it this way, and I'll ask you to consider it this way. The United States, in the 50-year period of time, alongside of the EU, Asian nations, let's call it the free world, set up a trading system. It's a system that has been tinkered with over the 80-year period of time. Yeah. Some adjustments would need to be made. If you want to make the system fairer to the Americans, we originally set it up so that it would be uneven for the Americans. We wanted rising living standards around the world, and so we allowed goods and services to flow into the U.S. relatively unfettered. We accepted tariffs from other countries. If you're now saying, well, we want reciprocal tariffs and it needs to be fair trade as opposed to the trading system that we set up, okay, but let's do that surgically, and let's do that with moderation, and let's do that with appropriate guidance so you don't shake $8 trillion out of the stock market. So again, but look, he's about attention. And so I think your viewers and listeners should pay attention to what I'm about to say. He just wants you talking about him. He's absolutely thrilled that he has Wall Street upset and he's got the banking community upset. And you and I are sitting here on this radio show talking about him because that's like the number one thing he wants. If he wanted to solve a problem, you certainly would not handle it this way with this level of hostility, the bellicosity of rhetoric,
so
the lack of diplomacy.
Wall Street veterans are watching with growing concern as political decisions send shockwaves through global markets. What was once dismissed as campaign rhetoric is now translating into real-world consequences, and the numbers are sobering. Trillions in market value have evaporated, retirement accounts are taking hits, and economic indicators are flashing warning signs. The current economic turbulence is avoidable, driven by counterproductive policy choices rather than external crises like pandemics. Similar to Brexit, political ideologies are clashing with economic realities, negatively impacting living standards and growth. The effects reach beyond markets, affecting retirement savings, small businesses, and workers in export-dependent industries. While Scaramucci's warnings paint a troubling picture of immediate political risks to markets, legendary investor Ray Dalio sees deeper structural forces at work. The founder of Bridgewater Associates, famous for predicting every major crisis since 1971, argues we're witnessing something far more consequential than typical market volatility. Let's examine why he believes we're at an inflection point that could redefine global capitalism itself. Here are clips from Ray Dalio's video.
I think that we don't understand how the cycle goes because it comes along about once a lifetime. But there are orders, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have, one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue. We can get into that. But there's a monetary cycle. There's a internal political order cycle that takes us from one political order to another political order, in which there's then classically great turbulence between the left and the right. And because of disorder, particularly in democracies, there's a lot of fighting because there needs to be cooperation, compromise, and so on. And we're in the process of changing that order. In addition, we have the international world order. International world order began in 1945. There's a war. You win a war. The dominant powers get to set the rules. That was a series of multilateralism, things like the United Nations World Trade Organization, World This and World That. And that multilateralism is then breaking down for unilateralism for the same reasons. So there are these three orders related to too much debt. Debt is money. Second, internal order. How does our system work? Who's going to get control of this problem? And then number three, in addition of the five main forces, there's also throughout history, climate, acts of nature. Droughts, floods, and pandemics have killed more people and toppled more orders. And then there's also throughout history, man's inventiveness and new technologies, which is creating this transformative result.
Right.
The interactions of these is what going on. So if we look at tariffs represent a dealing with the imbalances. The imbalance means we have a tremendous capital imbalance and a tremendous trade imbalance, which is unsustainable. And so that's the backdrop of this. So, I mean, what does it mean for a company? It means costs are going to go up, revenue is going to go down, and capital is going to be harder to come by. And so, and then we're trying to replace manufacturing. I mean, I agree with the problems, okay, about the fact that we don't manufacture and that there is a problem with that. But there's a structural problem of whether we can manufacture. We have a population that basically 3 million people, 1% of the population, is incredibly brilliant. I mean, they go to the best schools, they come out, they make the unicorns, inventiveness, half of which, by the way, are foreigners. And at the same time, they are making the unicorns. At the same time, what we have is 10% of the population around them that's doing very well. The 60% of the population has below a sixth grade reading level. And it's tough to be productive. So when we agree with the problem, too much debt, Secretary Bennett and others agree we should get it down to 3%. We have to get the budget deficits down to 3% of GDP. This is not, we all agree on the problem. The question is, what do we do about it? How do you create that self-sufficiency? And so from a practical point of view, that manufacturing is very difficult under this set of circumstances to create within the United States, yet it's needed. I agree with the problem, okay? I am very concerned about the solution, okay? The practicality of the solution. In other words, I think that this is going to create not only the problem, the capital markets problem that I'm talking about related to prices going up, costs going up, prices, revenue going down, and capital problem. But I also think that this is going to create great sand in the gears of production worldwide. At the same time, I do agree that this interdependency, this issue of productivity in the world in which we have to be competitive and productive, and we're not competitive in producing things, is a longer-term problem, not an easy one. And I do expect that it is going to have political consequences. This is the nature of the cycle. It is coming also at the same time as we have a budget issue. Now, the budget issue is a comparably important issue. So as we look ahead in the months ahead, we have to get the budget deficit down to 3% of GDP. I worry about that at the same time as this is happening. These are not easy problems to solve, I'm concerned, because the bigger problems exist. The debt exists. You can't get around the debt. The overspending exists. You still have that. You still have that competitiveness issue. These have repeated throughout history. We're in a period that's very much like the 1930s.
There's something unsettling happening beneath the surface of today's markets and politics, a convergence of forces that veteran economic observers recognize as particularly dangerous. We're not just looking at another business cycle downturn, but a fundamental rewiring of how the global economy operates. The numbers tell a sobering story. Debt levels have reached staggering heights worldwide, creating a fragile house of cards where one domino falling could trigger cascading failures. Meanwhile, the political landscape in major economies has become increasingly fractured, with consensus giving way to confrontation. This isn't just partisan bickering, it's a breakdown in the basic functioning of governance that makes solving complex economic challenges nearly impossible. On the international stage, the post-World War II economic order is showing deep cracks. The institutions and agreements that facilitated decades of global trade and relative stability are being tested like never before. New tariff wars and trade restrictions aren't isolated policy choices, they represent a fundamental rethinking of globalization itself. What makes this moment particularly perilous is how these challenges intersect. Political dysfunction prevents addressing debt crises, which weakens economic position on the world stage, which further fuels domestic discontent. It's a vicious cycle with no easy exits. Underlying all this is a workforce crisis that doesn't get enough attention. The mismatch between the skills needed for modern manufacturing and the actual capabilities of many workers creates structural barriers to meaningful economic transformation. The historical parallels aren't comforting. Periods where debt crises, political realignments, and global power shifts converge tend to be remembered as particularly turbulent chapters in economic history. While the exact contours of this transition remain unclear, one thing seems certain: the economic playbook that worked for the past several decades may need serious revision for what's coming next. This isn't doom-mongering, it's recognizing that we're navigating uncharted waters where conventional wisdom may not apply. The decisions made in the coming months and years will likely shape economic realities for a generation. One thing's certain, the usual playbook won't work this time. When even billionaire investors are sounding the alarm, maybe it's time to pay attention. As we wrap up, which scenario do you see playing out? Also, if you could urge policymakers to take one action to stabilize the economy, what would it be? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.